Have you ever wondered what's the difference between investing in ETFs and index funds? You're not alone. Many people get confused about these two popular investment options. But don't worry, today we're going to break down the key differences and provide you with practical steps to make informed decisions. When it comes to investing in stocks or bonds, most of us want a way to spread our risk and increase potential returns. That's where index funds and ETFs come in, two popular investment options that can help you achieve your financial goals. But what exactly are they? Let's start with the basics. An ETF is an investment fund traded on the stock market like individual stocks. It holds a collection of assets such as stocks, bonds, or commodities, and its value fluctuates throughout the day based on supply and demand. On the other hand, an index fund is a type of mutual fund that tracks a specific market index, like the S&P 500. To understand the difference between ETFs and index funds, let's look at some real-world examples. Suppose you want to invest in the US stock market through an ETF. You can buy shares of the SP 500 ETF Trust, which tracks the S&P 500 index. This option provides broad diversification and allows you to trade throughout the day, giving you greater flexibility. However, if you're looking for a more hands-off approach with lower fees, an index fund might be a better fit. For instance, you can buy shares of the Vanguard 500 Index Fund, which also tracks the S&P 500 index but has historically low fees and provides broad diversification. Let's take another example to illustrate the difference between ETFs and index funds. Suppose you want to invest in the technology sector through an index fund. You can buy shares of the Vanguard Information Technology Index Fund, which tracks a specific index of tech stocks. However, if you're looking for more control over your investments or want to invest in specific tech companies like Apple or Amazon, an ETF might be a better fit. For instance, you can buy shares of the Vanguard Information Technology ETF, which holds a basket of top tech stocks and offers greater flexibility. This option would allow you to tap into the growth potential of the tech sector while still maintaining broad diversification. Now that we've covered the basics, let's dive into the nitty-gritty details. One of the main differences between ETFs and index funds is how they trade. Since ETFs are traded on stock exchanges, you can buy or sell them throughout the day at the current market price. Index funds, however, trade only once a day after the market closes. Another key difference is fees. ETFs typically have lower fees compared to index funds, especially for large-cap indexes like the S&P 500. However, keep in mind that some ETFs come with higher fees, so it's essential to research and compare costs before investing. Let's take a closer look at the fees associated with each option. Suppose you want to invest $10,000 in an index fund that charges a 0.25% annual management fee. Over time, this fee can add up and eat into your returns. On the other hand, an ETF might charge a 0.05% trading commission per trade, which could be more cost-effective if you're making frequent trades. To illustrate this point, let's say you invest $10,000 in an index fund that charges a 0.25% annual management fee. After 1 year, your investment grows to $11,250. However, the 0.25% management fee would be equivalent to $27.50 per year. This might not seem like much, but over time, these fees can add up and impact your returns. Now that we've covered the fees, let's talk about the benefits of each option. Index funds are often seen as a more hands-off approach since you're essentially buying into a specific market index. This can be beneficial for those who want to invest in a broad range of assets with minimal effort. On the other hand, ETFs offer greater flexibility and trading convenience. Since they trade on stock exchanges like individual stocks, you can buy or sell them as needed. Plus, many ETFs offer unique features like dividend reinvestment, which allows you to automatically reinvest your dividends for long-term growth. One of the benefits of ETFs is that they provide greater liquidity. Since they're traded on stock exchanges, you can easily buy or sell shares throughout the day. This means you can respond quickly to changes in the market and adjust your portfolio accordingly. In contrast, index funds are typically traded only once a day after the market closes. While this can be beneficial for those who want to minimize trading costs, it may not be suitable for investors who need greater flexibility. To illustrate the importance of liquidity, let's say you're investing in a growth stock like Amazon. The price of Amazon shares can fluctuate rapidly throughout the day due to changes in market sentiment or economic conditions. If you're invested in an index fund that tracks the S&P 500, you might not be able to respond quickly enough to these changes and adjust your portfolio accordingly. On the other hand, if you're invested in an ETF like the Vanguard Information Technology ETF, you can easily buy or sell shares throughout the day. This allows you to take advantage of market opportunities and minimize potential losses. So how do you choose between an ETF and an index fund? Here are 3 actionable steps to consider. Firstly, assess your investment goals and risk tolerance. If you're looking for a hands-off approach with broad diversification, index funds might be the way to go. However, if you want greater flexibility and control over your investments, ETFs could be the better option. Secondly, evaluate the fees associated with each option. Remember, lower fees don't always mean better performance. It's essential to research the underlying assets and their historical returns. Lastly, consider the trading frequency and costs involved. If you plan on actively buying or selling your investments frequently, ETFs might be a more suitable choice due to their intraday trading flexibility. Let's take an example to illustrate this point. Suppose you want to invest in the technology sector through an index fund. You can buy shares of the Vanguard 500 Index Fund, which tracks the S&P 500 index but has a higher allocation to tech stocks. However, if you're looking for more control over your investments or want to invest in specific tech companies like Apple or Amazon, an ETF might be a better fit. For instance, you can buy shares of the Vanguard Information Technology ETF, which holds a basket of top tech stocks and offers greater flexibility. This option would allow you to tap into the growth potential of the tech sector while still maintaining broad diversification. In addition to considering your investment goals and fees, it's also essential to evaluate the underlying assets and their historical returns. For instance, if you're investing in an ETF that tracks the S&P 500 index, you should research the performance of individual stocks within the index and ensure they align with your investment goals. Let's take a closer look at this point. Suppose you want to invest in an ETF that tracks the S&P 500 index. You can buy shares of the SPDR SP 500 ETF Trust, which holds a basket of top US stocks. However, if you don't research the underlying assets and their historical returns, you might find yourself invested in companies with poor performance or high debt levels. To avoid this situation, it's essential to evaluate the underlying assets and their historical returns before investing. You can do this by researching the company's financial statements, management team, and industry trends. This will help you make informed decisions about your investments and ensure they align with your financial goals. In conclusion, investing in ETFs versus index funds is not an either-or proposition. It's essential to consider your investment goals, risk tolerance, fees, and trading frequency when making this decision. By understanding the key differences between these 2 popular options, you can make informed decisions that align with your financial objectives. Whether you choose to invest in an ETF or an index fund, remember that it's all about creating a well-diversified portfolio that balances risk and potential returns. And don't forget to consult with a financial advisor if you're unsure about which option is best for you. Before we wrap up, I want to encourage you to subscribe to our channel and activate the notification bell for more videos on personal finance. We'll be covering topics like budgeting, saving, and investing in detail, so stay tuned. As you continue your financial journey, keep in mind that education and patience are key. With a solid understanding of ETFs versus index funds and a clear plan in place, you'll be well equipped to tackle the world of personal finance with confidence. Let's take a final example to illustrate the importance of education and patience. Suppose you're new to investing and want to start with a $10,000 investment. You can put that money into an ETF or index fund, but it's essential to research and understand the underlying assets before making a decision. In this case, let's say you decide to invest in an ETF like the SPDR SP 500 ETF Trust. Over time, your investment grows as the market fluctuates. However, if you don't monitor and adjust your portfolio regularly, you might miss out on opportunities or take on unnecessary risk. To illustrate this point, let's say you invest $10,000 in an ETF that tracks the S&P 500 index. After 1 year, your investment grows to $11,250. However, if you don't rebalance your portfolio regularly, you might find yourself overweighted in certain sectors or underweighted in others. For instance, suppose the tech sector experiences a strong rally and the ETF's allocation to tech stocks increases to 25%. If you don't rebalance your portfolio, you might be exposing yourself to unnecessary risk by overinvesting in the tech sector. By regularly reviewing and adjusting your portfolio, you can ensure that it remains aligned with your investment goals and risk tolerance. That's why education and patience are key when it comes to investing in ETFs versus index funds. By understanding the differences between these two options and staying informed about market trends and performance, you can make informed decisions that align with your financial goals. Thanks for watching, and we'll see you in the next video.